corporate tax law. We all know that the corporate tax law is rolled out, and now it's time for us to be little informed of the law, so that we can adapt the changes in time, and so that we can be better prepared once it's implemented fully. So let's quickly start with the basic concepts of corporate tax laws. So let me give you a kind of exclamation at the start. Corporate tax law as a subject is very vast, and since we have a time limitation, so what I have done is I've tried to pick the basic topics which can give you an outer structure of how it will work and how it will be implemented. And I've taken few miscellaneous topics as well. But obviously, I mean, we can meet separately to discuss on any specific points. But for now, we have taken some basic points which can give you an idea how it will work, and what will be the impact on our businesses, what in general will be changed. So as an introduction, let me first give you a technical name of the law which has come out. So this law is named as Taxation of Corporation and Businesses, which means it's not just the tax on corporate, what we have heard from last 1.5 years. It's not just the tax on corporates, rather on businesses as well. Now, how does that make a difference? So businesses which are not yet registered will also be eligible for the tax liability. And just to give you a better clarity, it will be like if an individual natural person holds a rental income through his investments, and the same rental income when received from corporate. So to avoid a discrimination, FTA will charge taxes on both. So this is a law which will tax on corporations and businesses in specific as well. Now, as Mr. Hakim said, it is implemented. It was published in November, but rather, as per the law, it was effective from 18th of October 2022. Now, how does that make a difference, or what is the impact? So this law is already implemented from 18th of October. So whatever we are doing after the implementation date will have to be according to the law. But for our understanding and our concern, the first tax period or the income which is eligible for tax will commence from the first financial year after 1st of June 2023. So basically for us, let's say if someone has a Jan to December financial year, for him, the first financial year or first tax period which is eligible for tax will be 1st of January 2024 to 31st of December 2024. And likewise for April to March or any other tax period. Now, what exactly it is applicable to? So corporate tax is imposed on taxable income, not on all income. So it has to be, we have to derive the taxable income, and the rate we have to get from the authority. Now, who is it applicable to? So there are 3 types of legal entities which FTA has determined. First one being exempt, second one being taxable, and the third one being qualified free zone person. We'll go through these one by one to understand how these categories are and in which category we will fall. First one being exempt person. Exempt is basically where any entities which come in the exempt persons list will be exempted from the tax at all. Now, for most of us, it will not be a much useful thing because we will not fall in this. So we'll go through the list as it is. So first one is the government or government controlled entities, or any entity which is in extractive business. Extractive business is excavation of natural resources. Any entity in non-extractive natural resources, basically refining of natural resources. Then a qualified public benefit entity, qualifying investment fund, public pension fund, or any other subsidiary which is an ancillary business of above. And cabinet, since only the law has been published, The cabinet decision is yet to be published. So we are still waiting for more details on few of the topics. So in this as well, there will be other persons which will be determined by cabinet decision. Now the taxable person. Taxable person is something which we have to understand in detail. Now FTA has distinguished taxable person in two categories. First one is resident person. Resident person is any entity which is registered, recognized, incorporated in UAE, including free zone. So even if you have a free zone company or a mainland company, or in fact, an offshore company. For example, if you have an offshore company in Jabsa, it will still be considered as a resident person and it will be in the purview of corporate tax laws. Second one being incorporated or recognized outside UAE, but being managed and controlled in UAE. So an example can be a branch office of a foreign entity. Now that foreign entity is not registered in UAE, but if the branch is registered here, they will also be considered as resident person. Any natural person conducting business will also be considered as a resident person here. Now, this is something which few of us might be concerned and confused about, that what exactly will be considered as a business activity as per corporate tax law. Now, this will be decided by cabinet decision, and the decision will come most likely in next month. So any kind of categories for a natural person will be issued by the cabinet most likely in next month. The other type of taxable person is non-resident person. So non-resident person is majorly defined as any person who is not a resident but still has a permanent establishment. Now, from permanent establishment, we mean either having a branch or having a storage house or having just an office or an agent, but there are some exceptions to it as well. Now, second point is any foreign entity which derives UAE sourced income. UAE sourced income is a vast topic, but I'll give you a brief summary of it. Basically, if anyone is earning out of UAE, it can be anything. If they are selling goods here, if they are providing a service here, if they are insuring a property in UAE and the insurance is basically done outside UAE, still it will be considered as a non-resident person and the income will be UAE sourced income. Third point is has a nexus in the UAE. Nexus is basically any kind of connection which might be considered as that the income was sourced in UAE, but that will be specified in the cabinet decision. Now, third type of person is qualified free zone person. Going by the name, we have to understand that for being a qualified free zone person, you need to be registered in free zone. So now, if you are registered in free zone, a lot of us, we have a company in free zone. So we can opt this scheme of being a qualified free zone person, but we have to be eligible as per the given criteria. So the first criteria is that there should be enough substance which is generating the revenue. By substance, FTA means that we should be able to justify how exactly the revenue is being generated. How much of manpower do we have, what technology, what premise we are using. So all those things will factor in, and if we are able to justify, then that should be eligibility point or eligibility criteria fulfilled to become a qualified free zone person. Second one being is that person or that entity should not have opted out of the scheme. So basically, this is a voluntary scheme and we can still opt out of it. And we'll go through in detail why would someone go out of or opt out of the scheme. But if they have not opted out, then they will be a qualified free zone person. Then compulsorily they will have to comply with arm's length price and transfer pricing documentation. Arm's length price and transfer pricing both are very big topics, but just to give you an idea. So for arm's length price, any transaction which is done by a qualified free zone person shall be as per market standards and shall not attract any kind of anti-abuse rule. And the fourth one being they should be able to derive qualified income as per the cabinet decision. Now, the definition of qualified income is yet to come, but we think that FTA will most likely include any income which comes from overseas or which comes from cross inter free zones income. That will be considered as a qualified income, and we'll see how that qualified income is used in determining the tax liability. Now, some of us might be wondering that all these free zones, they have been promoting themselves, as a tax-free zone from last so many years. So how come FTA is able to tax them on their income? So what FTA has done is they have limited that incentive. So this scheme of qualified free zone person, they have given a cap of 50 years, that this scheme can be used maximum up to 50 years. So most likely after 50 years, every person here will be considered as a legal person, but obviously they can change the law and increase this time limit as well. Now, if any qualified free zone fails to meet any conditions, then it will cease incentive from the beginning of the tax period. So if at all, even at the end of the tax period, they are not able to maintain any of these eligibility criteria, it will still be a normal taxable person. Apart from this, there's another term which is called tax group. And this is specific for UAE because I feel that there are so many entities here who has several entities registered in the UAE, and then there is a structure, corporate structure, and then they have a HQ company differently. So what they can do is to avoid duplicacy and to smoothen the process. FTA has introduced a concept of tax group, where the parent company and subsidiary companies, they can form a tax group and they can file a single return. So, but obviously you will have to comply with the eligibility criteria. First one being that both the persons should be juridical persons. Juridical means all the kinds of corporate entities will be eligible and not a natural person. In this, what happens is a parent company has to make an application along with the subsidiary company or companies who wish to come into this tax group. So what this basically means is that any subsidiary which wants to opt out of this tax group, they can still do so. It do not have any foundation to come into a tax group. See, there can be different pros and cons of this, because if they come in a single tax group, there will be a single threshold as well. They will not be able to enjoy a threshold for each entity. So that's why some of the subsidiaries might not want that. So they still have that option. Now, the other condition we have is the parent company should hold at least 95% in share capital, voting, or profits. At least 95%. So most likely it will be a wholly owned subsidiary. It is not like if you are owning a 51% or 75%, then also you can have a tax group, just like VAT. VAT, you can have a tax group with reduced share capital as well. But in corporate tax, they have clearly mentioned that it has to be 95% plus. Second last point is both entities should not be either exempt or qualified free zone person. This is very important because if any of the entities is exempt, then there is no point of it being in a tax group. That's why they should not be either exempt or qualified free zone person. And the last one is the parent company and subsidiary company should follow same financial year and accounting standards. Otherwise, if you think, it will be very difficult for FTA as well as the company personals to separate it for the tax period and then make a different calculation for that period. So they should have a same financial year and they should have same accounting standards as well. Now, once the application is made to the authority and once they approve, they will be considered as a single taxable person, and that's why they will not have a separate threshold limit as well. They will have a single threshold limit. They will be considered as single taxable person. Now, what other impacts will be there of the tax group within the members. So the parent will be considered as a representative member only. So the liability of any kind within the tax group will be jointly and severally for each member. But there is a provision in corporate tax law where the liability can be made limited to one or more members. Now, subsidiary, as I told you, subsidiary has an option to join or leave a tax group anytime, and they can make an application to the authority. Once that is submitted, once that is approved, it will be done. Now, joining or leaving, how will the time period be considered for both of them? So for both of them, it will be considered from the beginning of tax period when that application is made. And there is another provision in corporate tax law where FTA might voluntarily, dissolve a tax group if the tax group doesn't fulfill the eligibility conditions. Now, it's a important concept, but for us, we do not feel that it's something which FTA has promoted a lot, because there are various restrictions on the offsetting of losses within the tax group. Even though a tax group is made of several companies, but not very flexible conditions are given for offsetting the losses or incomes. Let's move on to the next part, where we will understand the tax base, on what exactly or what is the purview of income tax law. What income will be taxed as per UAE Corporate Tax law. So first one is resident juridical person. So any entity or corporation registered, incorporated in UAE, for them any income derived within UAE and outside UAE will be taxable. Any income. So there is no excuse in that. Any income within UAE or outside UAE will be taxable. But for resident natural person, it is different. For resident natural person, income derived from UAE and outside UAE only for the business conducted in UAE. So how does that make a difference? Let's, for example, let's take, if I as a consultant provide a service or a support to a company registered in Germany, I go there as in individual capacity. And if I serve them in outside UAE, then that will not be considered as eligible income for corporate tax. But anything within UAE, obviously that will be considered as a taxable income. For non-resident person, it's very easy. So any income which they have derived from a permanent establishment in UAE, let's say if there is a foreign company, but they have a distribution center here and they sell it from here. So any income derived from the distribution center or UAE sourced income. For UAE sourced income, best example is, let's say, there is an insurance company which insures, any building here in UAE for a client based in Germany. The insurance company is based in US. Even though the transaction is outside the purview of UAE, but since the property which is insured is in UAE, that will be considered as a UAE source income, and that non-resident person will be eligible for tax. Same thing goes for income derived from UAE nexus as well. Now the most important part, tax rate. How much will be the tax rate for incomes? What will be the threshold? Let's first try to understand what will be the taxable income and what will be the threshold. So in corporate tax law, they have not exempted a threshold. Rather, what they have done is they have given a rate for the threshold. So below threshold, there will be a 0% tax. There's still tax, but at 0%. And for any amount exceeding the threshold, it will be 9%. Now, the threshold has not been defined yet in the corporate tax law, but most likely it will be somewhere around 100,000 US dollars or 375,000 UAE dirhams. Now, this is where the qualified free zone person eligibility criteria will affect. So for qualified free zone person, there is no threshold at all. So for qualified free zone person, 0% tax rate on the qualified income, which most likely will be overseas income or within free zone income, 0% on that income, and 9% on non-qualified income. So there will not be any threshold. And that's where that option of opting out of the scheme will work. So for example, if it's a small company, if it's a Sharjah-based free zone company, a small company which doesn't have a net taxable income, which is exceeding threshold, so they would want to opt out of that scheme and then gain the benefit of the threshold and not pay the tax, right? Otherwise, if they do not opt out and a qualified free zone, if they have a 10,000 dirhams of non-qualified income, they will still pay tax at 9%. Now, to understand everything, like, this will be tax and 9% will be the rate, but on what? So we have to understand what will be the accounting income and how we will reach from accounting income to the taxable income on which the tax will be levied. So accounting income in general terms, it will be the net profit or loss for that relevant tax period, as per our financial standards and internationally accepted accounting standards, whatever we have made. So whatever income comes from that will be considered as accounting income, but then we will have to adjust it accordingly so that it becomes a taxable income. We'll go through each point. These points are very vast in themselves. So what I have tried to do is I have tried to cover very, very few points just to give an idea on how these points will work. First one is unrealized gain and losses. So unrealized gains is, I'm sure everyone will be aware that as per IFRS and other accounting standards, at the closing of period, we have to adjust the fair value of the investments and stock and everything. So let's say if we buy some stocks in Saudi National Exchange, and by end of the year, the price increases, right? So, but we have not sold them. Now, even if we have not sold them, as per IFRS, we have to revalue them as per the market value, and we will show a profit in our books. Now, even though that is profit in our books, but we have not realized it. So corporate tax gives a provision to exclude those kind of unrealized gain and losses and consider them only when we realize it. So basically, if we sell them next year, so whatever will be the profit will be taxed in the next year, not this year. But this is a voluntary thing, and we have an option of doing it on realization basis, or otherwise we can still do it on accrual basis. But as per our understanding, we have to choose one option, and we have to be consistent throughout while opting for this option. Now, what are the types of incomes which will be exempt for everybody? So first one is the dividend received from a resident juridical person. So if you are getting dividend from Salik or any other company here in UAE, it is totally exempt in the hands of receiver. No matter if the receiver is a natural person or a company, this dividend received will be totally exempt. Now, the dividend received from foreign company, what will happen to that? So dividend received from foreign company will be taxable, except in one condition. So if at all we have a participating interest in that company. Now, by participating interest, we mean that at least 5% of shareholding should be with us. So if we are getting dividend from a stock we have invested in Saudi, and if we do not hold 5% of that company, that dividend income will be considered as an income. But if we hold 5% at least, then that will be considered as dividend received from participating interest and will be exempt. Income from any foreign permanent establishment. Now, this is very important. Let's say if a resident person, a local entity registered in UAE, you guys have seen that their whole global income is taxable. Any income, whether it's derived in UAE or derived outside UAE, is taxable in UAE. Now, if they have a permanent establishment in some other country and a distribution center, and they're earning income out of it, so there's a condition where that can be considered as a exempt income, but the condition is that that country or that jurisdiction shall have a tax rate either equivalent to UAE or exceeding the rates in UAE. So basically, if that country has rates more than 9% as of today, then only that income will be taxable, because uh, no one wants to double tax any income. So if it has been taxed in that country, then it will be an exempt income in UAE. Then there are some reliefs as well. Reliefs is basically when there is an intercompany transfer and it's not a tax group. So let's say if you have a sister concern in which is a 75% ownership at least. So if it's a 75% ownership, and if there's a transfer of assets or liabilities, any kind of things, then any income generated from that transfer will be considered as exempt, but there has to be some conditions which needs to be followed. First one is that both the entities should not be exempt. That's a basic condition which is written a lot of places in corporate tax law, and the basic rationale behind that is that if any of the entity in the transaction is exempt, then there is no point of including them in the reliefs given. So that should be not exempt. It should not be a qualified free zone person, and the transfer should be at the book value. Let's say if you own a fixed asset, a machinery in a company which you own, and then after some time you want to transfer it to a sister concern where you also hold 75%. You transfer it at the book value. Book value will be whatever price you had purchased, reduced by the depreciation or amortization. That book value, the transfer will be at the book value, since there will not be any kind of gain or loss, which will be kind of relief. But there's an important condition which needs to be followed, which is there should not be any reselling of that asset within 2 years. The second relief is the business restructuring relief. So basically, if someone is selling the entire business or an independent part of the entire business, that will also not be considered as a taxable income. But basic conditions, both the entities should not be exempt and both the entities should not be a qualified person. Now, in the taxable income, it is very important to understand what kind of deductions we will get and what are the expenses which will be disallowed. So the first and foremost condition obviously will be any kind of expense which we are making and which we are claiming should be wholly and exclusively for that business. If it's not for the business, then obviously it will not be allowed. Other conditions are the expenses should not have been incurred in deriving exempt income. Now, if any income is not taxable, so any expense which is made against that should not be taxable as well. Third point is the interest expenses. Now, a lot of startups worldwide, they take, they work on debts. They have a lot of interest liability. So here in UAE, FTA has kept a cap on the interest expenses. The law says net interest expenses cannot be more than 30% of EBITDA. Now, what do we mean by net interest expenses? Let's say if any entity has some interest income and some expenses as well. So what net interest expense will be a net off of both the amounts. And that amount, that net amount should not exceed 30% of EBITDA. EBITDA will be before the taxes, depreciation, amortization, and interest. So it cannot exceed 30%. But they have made some exceptions to it as well. So any kind of banks, insurance, insurance companies or natural persons. So for us, if we are doing any business activity without any corporation, uh, then we will still get the interest expense. For example, if someone has taken property on loan and have given it on rent, then for that rental income, the full interest will be deductible. But for a corporate, it will not be like that. They will have a cap of 30% of EBITDA. Same thing goes for the interest paid for loan taken from a related party. Now, some of us, I think, you know that it is a practice where what we do is we shift some money. Let's say we have to show some interest, we have to show some book some expenses in the entity. What we will do is we will uh, rent out some money from the personal owner's personal account to the entity, or owner's related parties to the entity. Then we will give them interest and we will claim that. So FTA has clearly specified that any interest which has been paid to a related party against any dividend payment or repurchase or capital contribution or any acquisition will be disallowed. But there is an exception where we will have to justify it. So prima facie, it will be disallowed. But if we are able to justify it that this loan was not taken or this interest was not paid to take the tax advantage, then we can still claim it. Then coming to the entertainment expenses. Entertainment expenses, any kind of entertainment expenses, whether to acquire customers or any kind of recreation, meals, accommodation, those will be disallowed by 50%. So only 50% will be allowed of the expenses incurred. And it applies to expenses incurred on customers, suppliers, promoters, or any kind of business partners. So those kind of entertainment expenses, and it's a common practice in UAE where companies give holiday packages to their customers or give them safari packages, but those will be allowed only up to 50%. Any kind of donations, grants will also be disallowed if they are not made to a qualified public benefit entity. Any dividend paid from a juridical person or an amount withdrawn from business by a natural person will also be disallowed. And this is very easy to understand that if the dividend income itself is an exempt income, so that dividend paid from an entity should not be allowed as a deduction. Now, the last point will be any kinds of fine, penalty, taxes, bribes, all those kind of spendings will not be allowed as an expense. Now, related party transactions and tax losses. Related party transactions is basically nothing but if we have made any kind of related party transaction, that has to be adjusted by arm's length price in transfer pricing documentation. It is nothing but the FTA wants to understand that you have not abused the corporate tax law and shifted any income for the benefit of any kind of entity. So you have to maintain arm's length price, and we have to maintain the transfer pricing documentation as well. And tax losses. Let's say if we have, this is one of the question which arises, that what about the tax losses? You will be taxing the income, but what about the losses? So losses can be offset without any limit on the period. So if you have incurred any loss in this year, it can be carried forward to n number of years, but it can be adjusted only up to 75% of the taxable income. So whatever is your taxable income for the current year, only up to 75% of that it can be adjusted. So basically FTA wants you to still pay the tax for the 25%. And the second thing is the tax losses are not allowed for the previous periods. Like if you want the current losses to be adjusted against the 2024 financial year, it is not possible. They have specifically disallowed that. Then FTA has also come up with some incentives and special reliefs, which are yet to be published in the cabinet decision. So like few of them will be given to small businesses. There will be some expenses, some incomes, which will be treated separately, but they are going to be published in the cabinet decision. Now, apart from these topics, what I also wanted to take up is the cycle of corporate tax. It's a very brief point, how it will impact us and how it will go, what should we do during this period. Because even though we might think that our first tax period is from Jan 24 to December 24, and our first return will be in 2025, why should we bother for the corporate tax as of now? But it is very important because as per law, it is already implemented and we have to follow the corporate tax law for current year as well. So we'll go through the transitional rules which are mentioned in the law. So the first and most important transitional rule is that the opening balances of the first financial year will be the closing balance of previous year. So if at all your financial year is Jan 24 to Jan to December, then this year's current year's closing balance has to be as per the corporate tax law, and only those will be considered as the opening balance. So this is something which is very important, which means you have to comply with the law in the current year itself, and you have to derive at the closing balances which suffices all the conditions in the law. So once that is done, then that balance can only be considered as an opening balance for next year. And obviously, I mean, if it has to be as per law, then it has to be following the arm's length principle as well. Now, they have specifically mentioned a general anti-abuse rule in which, I mean, FT also knows that people are very smart and people will, make some arrangement or make some contracts after the law has come to, to reduce the tax liability or, make any contract which will give them a cost in upcoming year to reduce the taxes. So any kind of agreement made on or after 18th October 2022. So that will be, if at all, that is attracting any kind of, deferral of payment of corporate tax, or if they are increasing the cost. So the general anti-abuse rule will apply and FTA will do the assessment. Now, how will the registrations take place? So registration for taxable person, unincorporated partnerships and exempt persons, that has to be done on or before filing the tax return. Now, for tax returns, if we have Jan to December as a financial year, our first filing will be 9 months from the closing date. So which will be 30th of September 2025. So we have to get registered before that. Now, FT has also given a provision where they might register ourselves voluntarily. So registration can happen in both ways. We can do it on or before filing the tax return, and the FTA might do it voluntarily for us as well. Now, what exactly will be needed in filing the tax return? Now, this is something which has not been published yet, but this is on our experience, and what might they require? They might require, the period, basic details like accounting income, what was your accounting basis, is there any tax loss you have taken, is there any tax credit you have taken, all those things. And there might be some other declarations which they require while filing the tax returns. Now, as I told you, tax period will be defined as your first financial year. But what if someone creates a company in May 2024? What will be the tax period for him? So for him, the tax period will be the part of the tax return which is required. So from May till December or whatever year they are following, that part period will also be considered as a tax period. Now, generally, the financial year will be the Gregorian calendar year, which is Jan to December, until unless entity has specified a financial year in their MOA. Now, for some of the individuals, if they do not follow any kind of financial year, it will automatically be a Gregorian calendar year, which is Jan to December. But we can still make an application to change start date or end date, start the tax period, but it has to be approved by the authority. Now, all this information can still be useless if we are not keeping the records properly. And I think that's where our partners at Tally and Wisdom Info Solutions will come into picture. Will guide you how to set up this accounting software and how to keep the records properly, because this is very important uh, part of the corporate tax law. Even after if you are complying with all the laws, you still have to keep all the records. Now, it has specifically been mentioned in the law that you have to maintain the financial statements. And FTA has also mentioned a requirement of audit. This is for the first time they've mentioned audit compulsory for some of the taxable persons type. Most likely it will be persons who are taking exemptions or maybe qualified free zone persons. So there'll be a compulsory requirement, but we should anyways maintain our financial statements in accordance with the law, following all the internationally accepted standards. If there is a related party transaction, then we should also prepare a master and local file, which will be required for the authority in deriving whether we have taken arm's length price or not. Let's say if any company has taken exemption status, then they will have to maintain those records on what basis they have taken exemption status for at least 7 years from the end of that period. Same thing for all of us as well. We have to keep our records for corporate tax return and taxable income for at least 7 years. So this is something, and I'm not sure if you are aware for the requirements in VAT. As per VAT law, now it is required to keep all the records for 15 years. So I think it will be still easy for us to keep records for 7 years. Now, when there is law, there's always a penalty, there's clarification, assessment. So just like that, we can still request, a private clarification from the authority if we are not sure on anything, or if we want to go to the authority for advanced pricing agreement for related party transactions, we can still do that. Now, FTA themselves, they can come and do the assessment, and they can also mention the circumstances and conditions under which the assessment will be requested. And obviously, if there are non-compliances, there will be penalties and fines. But most likely they will also come in the next cabinet decision. The last part where, what if a business liquidates? What if a business stops making taxable supplies or stops doing business activities? What happens, or how do we do the deregistration? So for deregistration, we have to apply to the authority within the prescribed time limit, and they will review the application. Then they will ask us to settle all the liabilities, all the dues which are there in our corporate tax profile. And once we do that, we have to file all the corporate tax return. Once that is done, then the deregistration process will complete. And FTA has also kept a separate provision where if there is any non-compliance from the client's end, from the entity's end, then the FTA may deregister themselves based on their records.